A $638 billion backlog sounds like an impenetrable moat, but for Oracle, the biggest illusion in tech right now is confusing a massive pile of signed contracts with actual business success. The true moat isn't signing the deal. It is the logistical and financial heavy lifting required to turn those promises into revenue, cash flow, and durable profit margins. Lately, Wall Street has been throwing a celebration for this transforming tech giant. The headline numbers are, admittedly, staggering. Oracle clocked a single quarter with $67 billion in new artificial intelligence infrastructure contracts. That pushed their total remaining performance obligations, or backlog, to that record-breaking $638 billion mark, which is an increase of 363% year over year. To the optimists, this mountain of unfulfilled orders represents a flawless bull case. It gives the company incredible revenue visibility for the next 3 to 5 years. After all, when you have 4 independent customers, each signing single infrastructure deals worth over $8 billion, it looks like Oracle has already run away with the AI compute leasing market. But seasoned, value-oriented investors are looking at these astronomical figures with a healthy dose of skepticism. Contracts are not cash. The real battle is whether Oracle can actually build out the infrastructure to fulfill them. Market caution isn't about a lack of demand. It is about execution. Short sellers and risk-averse funds are zeroing in on the $76.5 billion in backlog that Oracle is supposed to recognize as revenue over the next 12 months. The big question is whether Oracle can overcome severe graphics processing unit supply chain bottlenecks and rigid power grid constraints to deliver on time. If the physical construction of these data centers lags behind the explosive order growth, these paper contracts won't boost the stock price. Instead, the massive upfront commandage will simply drag down profitability. To understand the core tension, look at the sheer scale of the build-out. In the recently wrapped fiscal year 26, Oracle delivered over 1.2 gigawatts of compute capacity. Management expects to deliver nearly a full gigawatt in the first quarter of fiscal 27 alone. That accelerated construction pace is supposed to drive a major revenue acceleration in the second half of the year, which is why the bulls are anticipating a massive valuation re-rating. However, the bears are asking the tough questions about what this aggressive timeline does to the balance sheet. This intense level of building has already pushed Oracle's gross margins down by about 5 percentage points in fiscal 26, and management has explicitly guided that margins will remain under pressure through fiscal 27. This is exactly why the market hasn't fully bought into the hype. The immense depreciation and operating costs that come with heavy infrastructure investments are eating away at short-term profitability. Furthermore, pivoting this much computing power online requires an exceptionally stable supply chain and immediate access to massive amounts of energy. If there is a single hiccup in utility hookups or chip deliveries, the revenue conversion slows down. If that happens, those long-term contracts transform from a valuation premium into a heavy asset burden. The race to convert these orders is the ultimate deciding factor for Oracle's future competitive standing and its actual return on capital. The market's current repricing of Oracle hinges entirely on the time lag between massive capital expenditures and actual cash generation. According to corporate guidance, net cash capital expenditure for fiscal 27 is projected to hit roughly $70 billion. When you factor in client prepayments, the gross capital spending reported on the financial statements could exceed $90 billion. This highly asset-heavy expansion model is creating an immediate shock to the short-term income statement. Data center construction suffers from a fundamental mismatch. You have to spend the cash long before you can recognize the revenue and offset the depreciation. To fund this unprecedented expansion, Oracle plans to raise around $40 billion in fiscal 27, including $20 billion from equity issuance. While management has committed to not issuing new debt through the calendar year 26 to protect its investment-grade credit rating, a $20 billion stock sale represents a significant dilution risk for existing shareholders. It will likely dilute earnings per share in the near term, which forces us back to the most basic business question: is the return on investment worth it? Management claims that under steady-state conditions, their large infrastructure projects yield a return on investment between 25 and 29%. They also point out that $75 billion of the current backlog consists of customer prepaid contracts where the clients bring their own hardware. Under this model, where the client absorbs the initial capital burden, the returns on investment look even better. To hedge against rising upstream hardware costs, Oracle has introduced floating price mechanisms into its long-term contracts, sharing the inflation risk with customers. Because demand is currently stripping supply, they have the leverage to protect their margins. But whether this theory holds up under real-world pressure will dictate where the stock goes from here. The $75 billion in customer prepaid and customer furnished hardware contracts is particularly fascinating because it attempts to rewrite the traditional asset-heavy rules of cloud computing. Historically, the big risk for cloud providers was that borrowing billions to buy depreciating hardware would permanently damage their return on assets. By getting customers to pay upfront or supply their own chips, Oracle is shifting a massive portion of the funding pressure and inflation risk back onto the buyer. The bears, however, are watching the supply side. As the costs of core components like memory and solid-state drives surge, there is a risk that Oracle's floating price adjustments could alienate major clients when the broader market supply eventually catches up. If alternative capacity opens up elsewhere, these big customers might refuse to renew or demand renegotiations. So, is this $75 billion backlog guaranteed profit? Or is it a paper fortune vulnerable to supply chain volatility? The answer lies entirely in the upcoming balance sheets and whether those customer cash prepayments arrive on schedule to offset the billions in net cash outflows. Beyond the massive infrastructure conversation, the market frequently overlooks Oracle's legacy core business, databases, and enterprise applications. These segments are not just legacy sideshows. They are actively reshaping how the company's valuation model works through a multi-cloud strategy. Oracle is actively breaking down the historical walled gardens of the cloud industry. Investors used to worry that if customers migrated their data to rival platforms, Oracle would lose its grip on its core database users. But the latest financial data shows cloud database revenue grew 29% in the fourth quarter. Even more striking, multi-cloud revenue surged 404%, with quarterly bookings growing 325%. By deeply embedding its core database engine into competitor platforms like Microsoft Azure, Oracle is successfully capturing high-margin, sticky revenue from territory it previously risked losing. The flip side of this equation is the stagnation in traditional enterprise software, where growth has slowed to around 10%. Bears worry that without a new monetization engine, the software business will top out and drag down the company's overall multiple. To fix this, Oracle is trying to weaponize AI pricing. They have launched a new token bundle model for their enterprise applications, which has already drawn in over 30 large clients in pre-sales. More importantly, they're introducing outcome-based pricing. Instead of charging per user or per hour, Oracle plans to bill clients based on the actual business value generated by the AI, such as the volume of patients processed or job candidates screened. If this model works, software revenue will scale dynamically with client growth, effectively lifting the ceiling on their legacy business. The skeptical view is that these innovative pricing structures and multi-cloud strategies are in their infancy. They are nowhere near large enough to move the needle on total revenue today. Moving from a tool-based pricing model to a results-based model takes time to validate, and investors will need to see consistent, large-scale customer adoption over several quarters to prove this second growth engine can deliver high-quality cash flow. As we look ahead, the core thesis remains unchanged. The $638 billion backlog is a headline, not a competitive moat. The next few quarters will reveal whether Oracle is a master builder or an overextended giant. For investors looking to evaluate Oracle's execution, there is a clear watch list of catalysts to track over the next 2 to 4 quarters. First, monitor the exact compression of gross margins in the upcoming full annual report and subsequent quarters. Investors need to verify if the $20 to $25 billion in anticipated customer prepayments actually hits the balance sheet to cushion the massive capital expenditures. Second, watch the execution of the $40 billion financing plan. Specifically, pay attention to the timing of the $20 billion equity sale and how well the public market absorbs that supply without suppressing earnings per share. Third, track the physical delivery milestones of Oracle's massive data center expansions, particularly the hyperscale sites in Texas and New Mexico. The critical metrics to watch are clean energy grid connections and hardware supply chain timelines. Finally, maintain a close watch on how Oracle's capital constraints compare to its peers, especially Microsoft, as they compete for power and chips. If Oracle hits its delivery targets and uses its floating rate contracts to pass through inflation, it will successfully convert its backlog into massive earnings. If they run into grid delays, supply bottlenecks, or financing friction, the market will likely reevaluate its optimistic valuation. The numbers on paper are historic, but the real work happens on the ground.